Section 2 here, how the wealthy manage their money. The wealthy want control. And these are the big advantages of what we're trying to go for when we create one of these policies. Tax advantage. So again, when the money's in these policies and it's growing at say 4 to 5%, it's tax-free. And I don't know why. I know why. The IRS code says it is, right? And there's all these people lobbying that have these large life insurance policies, the politicians that have their money in here that have this good tax treatment. So when it grows at 4% tax-free, it's like a municipal bond, which it's actually, in the end of the day, it's seen as maybe 6 to 7%, depending where your tax bracket is. So that's one of the big loopholes, and one of the reasons that kind of pushes it over the edge, why there's some small marginal reasons why to do this. Liquidity, the store of your cash, just like a HELOC, right? You can pull your money out whenever you want. The asset protection, in each individual state, it's a little bit different, but for the most part, the way to think about this stuff is once it's in your policy, it's like how your retirement funds are off the table of litigators for the most part, or at least in worse off states, it's a lot harder to get to. It's not correlated with the stock market, and then it is guaranteed growth. And a lot of these companies that you're putting your money in, and as long as you don't go to one of these rogue insurance companies that don't really underwrite their people, these are probably the most stable companies out there and paying for like 100+ years. And these are the companies that are buying those large buildings in low cap environments that are just looking for capital preservation. It's when we invest in properties, we're looking for those Class B assets, secondary and tertiary markets, and we don't want to touch the large Class A asset in primary markets, but that's what these insurance companies invest in because they're going after stability and capital preservation. And the reason why they want that is they just want the money to be there so that they can fund these life insurance policies for you guys.
Yeah, and Lane, before we go for the concepts we're going to be covering today is mainly focused around the use of whole life as the vehicle for infinite banking. There are other vehicles. You could just use a regular checking account and do the same concept. The results will be much different, but there's also other permanent life insurance that are also somewhat popular. This slide kind of pertains to the use of whole life. So when we say uncorrelated, that's why it's uncorrelated. There are one company for whole life that has a feature where you can tie it. The returns could be tied to the S&P 500, very similar to IUL. But for the most part, whole life is looked at as uncorrelated.
Yeah, and the last benefit is, of course, the death payout. In case you die, you're buying a lot of insurance here, and it's the way we design it, or the way you want to design it, get it for death payout, but it's a secondary thing necessary, so you get the tax benefits. You have to buy insurance. So Tyler and I would probably joke around that if we died, our spouses and families would get a huge boatload of money where they don't invest or worry about anything for their dying days. And most people in the family office group, they get enough of this stuff built up, talking life-changing money, $2, $5, $10 million plus. We had a question here. Would like to know which one is better, whole life, infinite banking, IUL policies. Tyler mentioned that the difference is what is it built off of? We recommend the whole life. I feel like the IUL is for a different purpose, right? Whole life is where most people are at today, people that are under $5 to $10 million net worth. In my opinion, you get the IULs for something very different. You don't get it to store cash, but you get the IULs as sort of like a turbocharged annuity. But your net worth needs to be higher, and you need to be more what I call a lot end game. You're willing to take a lower return, but you want to guarantee. And then, of course, the other type of insurance that we're not going to be really talking about today is a term life. The purpose of that is, in case you die, you want your survivors to have a nice chunk of money. But that's what life insurance is for. What we're talking about today, the goal of the whole life overfunded infinite banking policy that we're talking about today, is you put money in, it grows tax-free. We have the liquidity so we can invest it and do something a much higher, better use for. There's a bit of that asset protection. And of course, the death payout is there, but that's a side benefit. We'll probably do another section on this later on about IULs. But to me, if you're not to end game, you don't have a high net worth of $3, $5, $10 million plus, I think you have different goals at that point, and I think that's where the IUL comes in.
Yeah, and just to add a little, the whole life is a stable, it's a lot more stable though. Your premiums, their expenses, they're set. When you acquire the policy, it's set for your whole life, and hence the name whole life. IULs, some of those fees and expenses could fluctuate along with the returns fluctuate a lot more because it is correlated to the stock market. So there's more volatility. And as Lane mentioned, there are different purposes. So yeah, IULs historically are able to project a lot higher because the average returns on S&P is 8%. Maybe you'll see 7 or 6%. But again, it's a lot more volatile. Also, Lane, before we go, the discussion about tax-free, technically it doesn't grow tax-free, but we're able to access the growth or the cash value in ways that it will be tax-free. So that's the other portion. If you don't do the right things, you could be taxed on that. You just have to make sure you follow the right rules, and we'll go over most of those today.
Walt Disney, these are just examples of entrepreneurs and life insurance. Walt Disney, when banks would not initially fund his construction plans, he became his own bank and borrowed from his own life insurance to develop Disney. Ray Kroc was able to pay key employees through his liquidity and his life insurance policy. And we'll get into this at the end, I think, in the more advanced topics. And this is where I really enjoy. You got this big chunk of money, like the different uses, and this is where you need a peer group. This is what kind of like the family office ohana is, right? Like these different best practices and ideas. A lot of us are using it in lieu of a 529 plan. 529s I'm not a big fan of at all for college education. For other entrepreneurs out there that are showing low income because you did not pay taxes very much, such as myself, it's going to be hard to get a qualifying mortgage. What some people will do is they'll buy the property cash and just take the loan from their life insurance to get leverage, because you always want to be using leverage, good debt appropriately. So this is just comparing the average versus the actual returns. Stocks, S&P, roughly 8 to 10%. I'd probably argue that it's lower these days, although it's been on a tear, mostly because of quantitative easing, which will probably be going for a little bit longer. I think what people don't realize with stocks, you go through these huge dips, and I think the phenomenon that a lot of people talk about is when you have these big dips, you're going to have to, your percent returns have to come back extremely stronger to get up to even baseline or get up to where your moving average was. So it is very misleading when you look at that stuff, which is why that kind of comes in with storing the value in these life insurance policies. When I first started to look at this, I'm always a skeptic. This is funky, right? Like, how are people making money off of this? And why are insurance companies doing it? But then what really gets me going is like when successful, wealthy people that are financially free start to use these strategies. That's really when I get interested and I start to backwards engineer what they're doing. I don't know if you want to talk about the rate, Tyler, but this typically, for a baseline example, we're using 4% here, that the money grows in these policies.
Yeah, so usually the true IRR, what policies can see is anywhere between 3.5 to 4.5%. Typical IRRs is what they're seeing over the life of the policy. Annually, it'll differ, and of course, you're catching up for the upfront cost for that first year where you have a negative IRR. But yeah, for the life of the policy, the IRR is about, what we're projecting is 4%.
So if you guys are new to this, you might be saying, that's not very good. But missing the point, right? Like when your money is not working, right? Think about it. I don't want to use the example of a craps table in Vegas, but I will, right? When your money is not on the table buying bets, it's sitting in your pocket, burning a hole, making 0%. But in this case, what we want, when our money is not on the table in syndication deals, in our rental properties, building equity upon it, when you got money in your pocket, and for a lot of us that are accredited investors, you may have 10, 20, 50, several $100,000 of liquidity just sitting right there. So that's what we're trying to do here. When our money is off the table, just as liquidity, we want it to grow at this tax-free rate here. So when what you want to be doing is you want to put your money in your cash value policy so it's making returns off the table, but then redeploy it onto there too. Like again, we said other applications, And this is where we look to a lot of you guys. If you guys want to, anybody's got any good ideas, you can type it into the question and answer box. Some things that we've used are 529 plans, which are the education savings or cover dells in lieu of that. Throwing your money into an infinite banking policy, not necessarily under your kid's name. And we'll get more into that. People think it's a good idea to do that type of stuff, which is a good idea, but it's such a small policy. It's not even going to move the needle if you put it in your kids, have them buy it. Using the own cash to take a policy to keep the debt there. We just had a hot seat in our mastermind where one of the members is using this to fund their IBC, but then to fund their other DeFi, other crypto staking dividend invest. And then this is essentially what I use as what I call my opportunity fund, which you guys can click on this article here to read more about that. But basically what the opportunity fund is, like, you're going into syndication deals, and let's just say the minimums are $50,000. Most guys here might have $150,000 in liquidity stuffed in the proverbial mattress or this checking account, half in your wife's checking account. But maybe a deal comes up. Cool, you have that. But what if another deal comes up? Right? You may or may not have that readily available. But that's what this infinite banking policy is. So you have dry powder around in case you lose your job, in case there is the opportunity for a better deal coming. Another guy here is they do that stock investing, infinity banking is I think what they call it, where they go into dividend stocks. Another good example of things that people will use these policies in combo with.
Yeah, and for me personally, in lieu of 529, so I'm using it instead of a 529 along with long-term care. Not saying that's the best solution, but I just like the flexibility, the 529s. Also long-term care, you're locked in for the use of those funds for those specific types of expenses. Putting it in the policies, the cash value grows. Then I'm able to use that cash value for anything. It could be for college expenses for my children or long-term care in the future. But for me personally, that's kind of other applications, just the freedom to use the cash value how I please.
Yeah, and another reason I don't like that 529 plan is you're stuck within those garbage options, just like a 401k, right? Like you're just stuck with all those mutual fund, high expense ratio or high hidden expenses. And then a lot of those mutual funds have carried interest issues with those. And that's the whole thing that kind of powers the way I've been investing for over a decade now, is just getting off the retail stuff, right? The retail stuff is what builds these big buildings for these companies, pays high executive salaries. They try and make it all complicated to confuse you guys, but I think a lot of you guys have realized that it's not that hard to invest on your own and cut out all these middlemen. So this infinite banking policy setup is exactly what you guys need to have the choices of what you guys want to do with your money instead.